Hey guys, another Friday again. These things sneak up on me really, really fast. I don't know how you live your life and your timing, but since we're living in the mortgage industry, it comes for us. We live our life in 1 month increments, right? Because there's all these 1 month, end of the month things that keep happening. As far as I'm concerned, you get the deal done when the deal is capable of getting done, but you have contracts and people put time frames, and then they want to penalize people for not meeting these time frames when there's so many uncontrollable things out there. It's just it can be a real heavy exercise in frustrations, right? To build systems and processes to make sure we can accomplish that the best that we can. But we're getting barraged with all these crazy changes that we're having to endure, but we still seem to be continuing to do pretty well. So I'm pretty confident that we'll continue to keep building and growing and experiencing better things all the time, even though we're constantly seeing these changes come and kind of hit us in the sideswipe us, and we're not even ready for them. So where we're at today, let's talk about our charts. We're going to get into the 3.0 because that's what I have available to me. 4.0 is a little bit different. It's actually showing things a little bit lower than this. But we're seeing things we're seeing a trend. It's an upward trend line. I'll show that on a different chart where I've kind of drawn that out differently. But stocks are rebounding after the decline that they had yesterday. And even though mortgage bonds are in really good shape, I mean, it's not a bad position to be in. We're off of our better levels yesterday, but when you consider the trajectory, we're heading in a very, very good direction. Now, that doesn't specifically translate to where we're getting the money because we can't use the mortgage-backed securities because of what the Fed has done or what the U.S. Treasury has required. And then you've got the FHFA, Federal Housing Finance Administration. Mark Calabria heads that up, which there is some talk that maybe the next guy is going to make this 7% thing go away. We can't say that it will, but that could change things. But at least we're seeing some positive movement out there in the bonds, even though stocks are taking from a lot of things and getting some life breathed back into them from that sharp decline they had yesterday. The 10-year is off, actually. The 10-year took a bit of a hit. Let me show this. The 10-year, when people are looking at the treasuries, like we talked about before, they start to see where they're thinking, that the 10-year is going to go the same as the other. It's still kind of in negative territory a little bit, but it's still in very, very good shape from where what we always look at. So one of the other things I want to be able to share with you is let's take a look at the 2.0. This is one that we look at for like your very, very, very lower coupons. And I've drawn the trend line here because I can draw on this one. And in drawing that trend line, you can see we're in this channel where we're going upwards, meaning that rates are getting better because money is flowing into those pools. And you can see today we're right here. We're barely making any movement. We opened lower than when we closed yesterday, quite a bit lower, gap down. We closed that gap from where it started, but now it's just kind of sitting there. Let me see if I can zoom in on that. In fact, looks like I can. So it's not really making any movement at the moment. So it's kind of sitting still. It did move up a bit, but then it's sitting on this resistance is where we're sitting at the moment. So I guess, a lot of people, I keep talking about inflation. We talk a lot about where things are going. A lot of people ask where are rates going to go. What is my prediction? I listen to a lot of people. I listen to a lot of folks out there. I've had Barry Habib on to here before over a year ago. And, and we're trying to understand what is happening, what's going to drive things. Now, if we look at what Barry talked about today, the Fed's balance sheet, he said that the balance sheet right now is in excess of $8 trillion. That's a lot of freaking money. In excess of $8 trillion is on the Fed's balance sheet. Now, after the Great Recession, they had got $4 trillion on the balance sheet, and then they started to try and taper back in 2013. You ever heard the term taper tantrum, where the market kind of freaked out about their talk of taper and then they couldn't, so they kept taking more and more on the balance sheet. Now we're in excess of $8 trillion. So what does that mean? Well, one of the explanations he gave is he doesn't seem to have a whole lot to worry about. I stress about that kind of stuff, with all that monetizing of things, is the creation of money. Well, he had explained that not all that's going into the market, a lot of it is on loans. So they're creating loans out there and they're lending it to the market. So they're kind of like a bank. They're lending that money out. So that's how they're stimulating the economy with it being lent. So it really is being lent. It's going into mortgage-backed securities. It's being lent out so right in here, it's going into here. A lot of those funds are going into these pools. That's why they have a balance sheet of $8 trillion in bonds. Well, with that, lending that out, they're collecting the interest on this. Now, as we know, this low interest, with inflation, they're not getting any real return. This is a 2.0, right? They're saying inflation is 4.1% or high threes, depending upon which metric you're looking at. Well, they're not making money on this, right? So how's that improving things? Well, let's talk about what's going to happen when they finally start to, the economy starts to open up, the world's opening up, you got goods coming in from other countries, you got people starting to work again, and the stimulus starts to kind of back off, and then that stimulus wears off. Then what, right? He talked a lot about the fact that we're going to have now this burden of debt, $8 trillion, right? That is on their balance sheet, therefore being lent out through the Treasury and through the T-bills and through the mortgage-backed securities and other things that they've gotten themselves involved in. Well, this big burden of debt, what that's going to do, right? There is a belief that burden of debt could have a positive effect on the market with our economy starting to get a little bit better and people working. Then you have this debt that's got to get paid off. It's going to possibly, the thought, right, could potentially improve upon their interest rate position. So I don't know until I see the effects of it. I can't say. I've never experienced this kind of thing before, but I do listen to people who are much smarter than me, who've been at it longer than I have. Barry's been at this for probably 45 years. I'm guessing. I've been at it for 23, coming up on 24. So I'm going to lean on the guy who's been at this for a lot longer and see and hope that he's right. But in the meantime, what are they saying to do with that? They're saying, well, rates are going to go down, so you can refi people again for a lower rate. You know me, on lower rate, I think that's completely foolish to refinance just because of low rate. And I'm going to come up with some stuff. I'm going to show you guys on here and illustrate with numbers how foolish I believe it is. So if you're going to refinance, pull cash out, take that money, buy more properties, invest in other things. Don't let the money sit in cash where it's just eroding. And then go to the website, scroll down, aaron.chapman.com, scroll down to the donate button, check that out. Now we've been seeing some people still putting capital in there, and it's a great thing. I'm hoping to be able to bring you the results of that and what has happened with those funds here in the near future. Talk to you real soon.